Hopefully everyone can see those okay. So today we're going to use the energy crisis to talk about how do firms, and understand a little bit more, how do firms respond to economic shocks in real time. As Beth already mentioned in her kind introduction, this is work with Jakob Schneebacher that heads the Microeconomic Analysis Unit at the Competition and Markets Authority, and Professor Timo Fetzer at the University of Warwick. I urge you to look both of their work is brilliant. And the project started in December 2022 under the umbrella of Timo's sort of broader research on the impact of the climate crisis on households and firms. Beyond this talk and after this talk, if you're interested in the project, there are working papers published. There's a working paper published on a couple of working paper series. So there's a Cage Warwick working paper. It has also been published as a working paper as part of the CMA working paper series on the gov.uk website. It's also out as an ESCO working paper. And then there's a more sort of summary blog on Vox.eu called Navigating Economic Shocks, and another blog on ESCO. So you can read it in whichever format you prefer if you want more detail after the talk. So let's begin. We have gone through a tremendous spike in energy prices and the energy crisis that ensued. Energy is a fundamental factor of production for many firms. As we're going to see later, firms on average spend a little bit more than 12% in the UK on energy as part of their intermediate consumption. But for some firms, it's a lot more than that. It's closer to 40%. Gas prices following the invasion of Ukraine by Russia in February 2022 jumped to, on average, 7p per kilowatt hour. This is roughly 4 times the pre-invasion average, which is what you see on the graph here to the left. This is a huge jump, a huge spike, unexpected, sudden spike in firms' input costs. So it's obviously of huge importance suddenly after the invasion to policymakers, how they should respond to this crisis and what should they expect, what is the impact of this going to be on various economic outcomes. And I've put here a variety of sort of forecasts that came out at the time of the energy crisis, when the energy crisis hit. These are forecasts from reputable forecasters like ECB or sort of Oxford Economics or Goldman Sachs and various others. And you really see that when the crisis hit, there really was a lot of uncertainty about what this means. How serious is this? What is going to be the impact on the economy? So you will see that even for sort of sometimes similar sounding scenarios, the impact to GDP, the forecasted impact to GDP varies a lot. So there really is a lot of uncertainty about how best to respond to this, how quickly, through what means, to target whom. And the best example of this friction, let's say, really is Germany in a way, because in the debate on whether Germany should retaliate by cutting off imports of Russian gas, immediately a lot of industry stakeholders said that this would have an apocalyptic effect of GDP of around sort of 12%. But a paper by some prominent economists, the Bachman et al. What If paper, for some of you that may have come across it, estimated sort of a production function to try and estimate what the impact of GDP would be for different substitutabilities of energy, for different abilities of firms to substitute out energy out of their production processes. And they said that if Germany does decide to cut off imports of Russian gas, it will result in a contraction of GDP, but in a much more manageable contraction compared to other recessions that Germany has had to deal with, like COVID in the most recent years. So in a contraction closer to 2%, and nothing as apocalyptic as what some other sort of industry stakeholders were saying, closer to 12%. And this really escalated to the point that a government official in sort of a popular talk show in Germany turned around and said it's dangerous when economists play with their little mathematical models. Which is to say, this is a real friction in policymaker in the policymaking space, and this sort of fog of war in not knowing what will happen and how quickly and drastically policymakers need to act is a real issue. But it's also to demonstrate that there's a real need, a real gap for sort of real-time evidence, real-time data, and real-time toolkits to evaluate shocks as they happen and as they unfold. And of course, it's not just the energy crisis that showcased this. COVID really increased government's appetite for real-time indicators. But this is yet another example within the space of 5 years where sort of real-time evaluation would have been invaluable in acting promptly, quickly, accurately, and sort of targeting the right business in the right kind of way. So what do we do in this paper? The results we find in this paper answer the very, very immediate question of there has been a large shock to firms' energy costs. How did firms react? This is not just relevant in understanding the current energy crisis and the sort of incident that we just experienced, but it also speaks to the broader question of how we can design sort of optimal policies for the net zero transition. So if you think about what the energy crisis represents, what these adjustments by firms represent, they represent how firms respond to a higher price of carbon, something that is very likely to be a tool for policymakers to adjust to net zero. So the results we find, the elasticities that we find, speak to this broader question of how should we design policy for net zero. But they also speak to a kind of much wider question, even outside of the energy crisis and the particular policy challenge of net zero, which is how can we measure outcomes in real time in ways that are useful to policymakers? So how does this paper contribute to these three sort of umbrellas of questions? First of all, at the time we started, it was the first project to shed light on firm adaptations in the face of the current energy crisis. Of course, there's sort of evidence before from oil price shocks, etc. But it was the first paper to have real-time enough information because of high-frequency surveys and administrative data that we provide through the ONS to make an evaluation of what is going on in the current energy crisis. It did so in a way that looked across different types of businesses and structural transformation at different margins. So it really went deeper than sort of your average economic impact. Just a second, I need to drink some water. It created a purpose-built data infrastructure, or in sort of more intuitive terms, a shock response toolkit, a toolkit that, while we use it here to understand the energy crisis, can be used to provide, it's a blueprint, a prototype of how we can provide evidence using real-time microdata to better inform industrial policy design. And finally, it accounts for this large heterogeneity, this large variety that I mentioned before of adjustment of different businesses and different margins, as well as the variety in the timings of when businesses adjust in the short, medium, long term across these different margins in a structured way. And I'll come back to what I mean with this structured way in a couple of slides' time. So what do we find? Let me sprint to the results so that you sort of know where we're going before I take you through the journey of how we actually got there. So how did firms react to the energy shock? We find that on average, firms passed through some costs, increased their cash reserves, and debt obligations worsened. We do not yet see increased redundancies or bankruptcies within the window of the data that we're looking at, which spans all the way to August 2023. Of course, the worsening of debt obligations is a red card, does ring an alarm for potential bankruptcies or redundancies later, but we do not yet see increased redundancies or bankruptcies within the window that we're looking at, which is roughly all the way up to a year and a half after the invasion. But we find that heterogeneity, the variance, the variety of responses by businesses is really, really important. So this idea, while we want to know the average treatment effect, the average treatment on the average firm on the economy, there really is very, very vast differences in when firms respond to the shock and how. So the dynamics, the timing of the response seem to be quite different for large and small firms. Large firms seem to invest and absorb costs, whereas small firms seem to be much more reactive in terms of passing on the costs to consumers. And when we use a clustering algorithm to identify whether there's archetypes of these kind of different adjustment responses in the data, we do find that there's sort of systematic clusters of adjustment across these various margins. And we'll get back to that in the end. What are these archetypes and how we cluster to find them. Let me now that I've sort of told you what we find, let me now take you into the journey of how we actually got there. So this paper is made up of 3 key ingredients. We have a measure of the energy price shock. We need to understand how exposed firms were to this crisis, and to do that, we need to understand how much energy they're using. We're using a rich, high-frequency survey-based measure of loads of different outcomes for firms, their turnover, their expectations, their prices of materials, their prices of goods sold, capital investment, their cash reserves and stock levels. For this rich survey-based measure, we have harmonized and assembled longitudinally for the first time the Business Insights and Conditions Survey. This is a survey that the ONS developed during the pandemic to pulse check how firms were responding in 2-week intervals to sort of the evolving COVID crisis. And for the first time, we have harmonized it and assembled it longitudinally to use it for research purposes and really take advantage of the richness of information that it provides. And finally, we also leverage high-quality administrative data, the longitudinal business database, which is a data set put together by the Economic Market Data Transformation team at the ONS. This brings quarterly different snapshots longitudinally of the interdepartmental business register. And in this instance, it allows us to look at exit in the business population, because exit and also number of sites. So how do these 3 ingredients come together? At the top here, you will see sort of our energy intensity measure comes from the annual purchases survey. We use pre-crisis data because we want to understand exposure. We need to look at how much energy firms were using before the crisis hit. We use the 2018 annual purchases survey, and for firms that we don't have 2018 information for, we go back to 2017. We do some outlier filtering to take out firms that seem particularly unusual in terms of the amount of energy they spend as a ratio of the expenditure in intermediate consumption. And we link this energy intensity measure to our Business Insight and Condition Survey, waves 1 to 89, this longitudinally assembled data product that we've created, and to the longitudinal business database, which are the sort of outcome variables that you see in blue there. So let's first look at the energy intensity measure. This is quite interesting, even if you're not interested in the energy crisis from a measurement perspective. And it's important for me to convince you that we are actually capturing correctly how firms are exposed to the energy crisis. So our energy price shock measure comes from, as I said, the annual purchases survey. From the annual purchases survey, which is the statistic I'm going to refer to, is from the graph to the left, firms on average spend about 12% of their intermediate consumption on energy. In our March sample, which is the first column, firms spend a little bit less than 10. So in our March sample, because we bring survey data sets together and larger firms are more likely to respond to surveys, our energy intensity is a little bit lower. That's because, as you see on the right-hand side, large firms, and this is the distribution that is more towards the left, the dark blue, larger firms are a bit less energy intensive. So when you bring surveys together and you're more likely to have larger firms in the sample, our average energy intensity is slightly lower than the average we see in the population. Some of this difference is also because we're trimming outliers. So we're trimming sort of observations that look particularly unusual. The impact of that is the middle column. So the APS when we trim outliers. But how do we know, how can we make sure? We need to check that this expenditure measure that we're using, that looks at the expenditure on energy as a share of the expenditure of total intermediate consumption, accurately captures how much firms how much energy firms are using. So firms may face different prices. So there are reasons why the expenditure might not fully reflect how energy intensive their production process is. To do this test, and most of these tests sense checks, if you like, that I'm going to show you in the next couple of slides. We don't have firm level information, but we do the best that we can at industry level to cross-check and sense check our expenditure measure with other measures of energy intensity. So because firms face different prices, we really want to look at the volume measure, a quantity measure, and here we have log gross calorific values, and you do see the y-axis is our expenditure measure, and you do see that the two are nicely correlated. So it does seem that our expenditure measure does capture quite well the amount of energy that firms are using. But you might argue firms are exposed to different contracts, not just different prices. So despite it capturing how much energy they're using, it might not necessarily reflect how much their payments may increase. We use data from ONS's bank transactions statistics, so looking at direct debits and credit payments at a high industry level to look at whether the payments that went out of that sector in terms of energy direct debits match or are aligned with our survey-based energy intensity measure. And indeed, you see that it does seem that the payments, the transactions that we see from these different sectors do match the energy intensity expenditure measure that we see from the annual purchases survey. But finally, if you're sort of, if you are a skeptic, you might go even further and say, well, it's not just about whether the payments match sort of the average expenditure in the survey on average, is about where that is the case dynamically. So even though sort of on average, everyone will have to eventually pay those higher energy prices, for pre-exposure to be relevant, it has to be that it does reflect how hit firms were when the war began. So it can't be, and this is sort of a challenge that some people have brought forward, it can't be that very, very large consumers of energy, like, I don't know, imagine a large manufacturing organization, like, I don't know, maybe Jaguar Land Rover or any other large sort of manufacturing business that you might think of. It can't be that these businesses, for instance, buy their energy in advance, and as a result, when the crisis hit in the short term to medium term, they actually weren't exposed to these higher energy prices. So what we have done here is we have looked at price per kilowatt hour of different users of energy, so going from very small to extra large consumers of energy, and how their pence per kilowatt hour price evolved quarterly from 2020 to 2024. And ultimately, what you see is that prices, of course, there's some variance between really, really small consumers and larger consumers, but ultimately you do see that after our treatment period, so after the war hits, the prices go up for everyone. The trend, the lines sort of move together. Quite reassuringly, the energy intensity measure that we use is also consistent with what firms are saying they're doing. So in the BICS, because it's such a high frequency survey and it allows us to add questions to understand what's happening in the economy quite flexibly, while the energy crisis was unfolding, the BICS team at the ONS added some questions to ask firms how were they adjusting, how affected they felt by the energy crisis, what actions they were taking. And when we look at this is one of these questions, what actions, if any, has your business taken to reduce energy costs in the last 3 months? And when we look at what actions businesses are saying they're taking, indeed firms with higher energy intensity are more likely to say that they took at least one of these actions. So I hope so far I have convinced you that we are meaningfully and correctly capturing how energy intensive a firm's production was, and that is indeed a meaningful measure for how exposed they were to the crisis. So let's move now to the outcome variables. So now that we know we have captured exposure, what are the impacts that we care about to measure? So we try to be comprehensive. We try to look across the firm's production function at all the relevant variables, the relevant margins in which a firm can adjust. So a firm produces output, signified here by Q. It sells that at a particular price. It combines capital, labor, energy, other intermediate inputs through a process, which we've here indicated through the function indicator. And we assume that a firm will operate profitably, and if it doesn't, or if it can't, at some point it will exit. So we also care to look at survival. We look into the BICS and the longitudinal business survey for all the variables that can capture each one of these elements of a firm's production function. So turnover, exports, variables for prices of goods or services sold, prices of materials, used expectations about these prices. Regarding the input mix, we have information on whether firms adjusted their capital. We look at redundancies to understand adjustment of labor. In terms of processes, we look at variables like working from home. Did you change how you operated your business? Stock levels, cash reserves. And in terms of survival, we'll look at exit from the longitudinal business database, but we also look at self-reported indicators of risk from the business insights and condition survey. So whether firms say that they are experiencing a higher risk of insolvency, higher risk of redundancies in the last few months. And we set out what our hypotheses are. So we expect prices to increase, for turnover to go down. It is unclear how the input mix will adjust. There's some evidence in the literature that we should expect cash reserves and stock levels to go up. And of course, in terms of survival, we expect bad indicators, so risk of redundancy and exit, to increase. But of course, given how many degrees of freedom there are, given how many variables and how many dimensions we're checking here, it is really important for this research to be credible and to be relevant to policymakers, to have some form of pre-commitment. What do I mean by that? When you're checking across all these different margins, statistically speaking, you are likely to find one relationship that is statistically significant. So to give credibility to the research, to show that you're really not mining the data to find some relationship that has ended up having the right p-value, we, in December, before we had seen the data, before the data we're using even existed for some of these outcome variables, we publicly and irreversibly published a pre-analysis plan. This is an analysis plan that tells you what methodology we're going to use and what hypothesis we're going to test ex ante, in advance, before the analysis has started, and it's published in the Open Science Foundation. This is actually quite a common practice in many disciplines, not as much in economics as in others, but in other disciplines, especially when experimental, or in this case, quasi-experimental methods are used. It is quite common. And it's good practice, especially when you really aim to go very, very deep in all these adjustment margins and all these different types of heterogeneity that we're going to investigate in the data. I'm not going to sort of stay on this for very long, but for anyone in the audience that is technical and a fellow econometrician and would like to know a little bit more about the methodology, we basically estimate, adopt a shift share style empirical strategy where we interact the unexpected shock. We take advantage of the nature of the unexpected invasion and interact it with the differential exposures, or energy intensity measure varies at firm level and gives you differential exposure for different types of firms, and regress these against all these different outcomes that I just presented, to understand how firms that are more energy intensive reacted differently before and after the crisis compared to less energy intensive firms. We control for loads of characteristics of these firms because you really want to saturate the specification with as many controls as possible, be as demanding as possible to make sure that you are capturing the pure energy intensity effect. So what do I mean by that? If we don't control for industry, we're comparing bakeries to manufacturing plants of whiskey. So someone might say, well, it's not really that energy intensity here drives these outcomes, is that the production process of manufacturing firms that manufacture beverages is fundamentally different to bakeries. You start controlling for industry at one digit level, which is the SIC one here, which is sort of the higher, the coarser industry level of industry disaggregation. And you say, okay, let's compare manufacturing firms to each other. Does energy intensity still matter? As we go deeper and deeper and deeper into these fixed effects, and become more and more and more demanding about how narrowly we're comparing firms. How much are we stressing? These firms have to be of the same size, of in the same region, of the same very, very finely defined industry. So at SIG 5, for example, so the most demanding, the dark red, we're really asking the model to tell us, do more, let's say, energy intensive bakeries in London that employ 10 to 50 people have different outcomes to other less energy intensive bakeries in London that employ 10 to 49 people. So you really are asking, is this really an energy intensive effect? Is it really energy intensity that drives this even within very, very, very similar firms? Very good. So what do we find? I've already showed you this up front. Here we've created this FIFA chart to put all these different dimensions together. So if you plot the coefficient of interest, so the responsiveness, the adjustment against these different margins, and we have sort of prices at the top, turnover expectations, export and capital, cash reserve, stock levels, to see what is the profile of adjustment across all these different things that we investigate. We find that on average, firms pass through some costs, increase their cash reserves, debt obligations worsen, as we said at the beginning. We don't really see increased redundancies in the BICs. There is some increase in the LBD. The dynamics are quite different for large and small firms, and I'm going to move into that in the next slide. And as we move closer into heterogeneity and how these adjustments vary for different types of firms, you're going to see that they vary a lot by industry and size. In this particular graph, we already show differences by size. So the gray FIFA chart reflects small and medium enterprises, whereas a dark blue, large ones. And you do see that large firms tend to invest and absorb costs, so their capital adjustment is a bit higher, where small firms tend to pass through more. So their price adjustment, the price points in the graph are a bit higher than for large firms. For this, we have defined the point of impact, the treatment period, if you prefer that term, to be November, the November before the invasion. This is because in the previous graph that I showed you before with gas prices over time, you already see some movement. The spike hasn't yet happened, but there's already some movement in gas prices. So you really want to make sure that you pick as your point of impact the time where reasonably you could expect firms might start adjusting expectations in their behavior. So firms might start expecting that tensions might result in higher energy prices in the future. We re-estimate our results for our impact period being February, so the moment of invasion, and it doesn't make a material difference. We investigate across all the different margins. Here I've picked 6 just to illustrate this exercise. The difference between above and below median energy intensive firms over time, so for each wave, just to track whether there are pre-trends, or whether we see movement in some of these variables before what we've assumed is our impact period. And you don't for most of our headline variables. There are maybe a couple, and they are pointed out in a separate graph in the paper. I've only included one here, which is prices of materials, where you do see a little bit of movement before our November impact period. As I mentioned earlier, there is significant heterogeneity, not only between how different types of firms adjust, but also when do different types of firms adjust. Again, we have estimated this for all the variables that I presented before. Here I've used prices just to illustrate this exercise. And you see that, for instance, smaller firms react much quicker in terms of prices. So we've broken here the treatment effect, so the impact in quarterly windows, and estimated it for small and medium enterprises, which is the green, and for large, which is the orange. And you see that the green line jumps up much quickly and gives us a significantly positive response in terms of prices much more quickly. Whereas the orange line, which is the large firms, is a bit more muted and turns insignificant as we venture more towards the summer of June, July 2023. So not only is there heterogeneity difference in how large and small firms respond, but also in the timing of that response and that adjustment. To test that what we're finding is a credible average treatment effect. So it's not driven, something that we're worried about here and we're worried about in general when doing quasi-experimental analysis is the extent to which we've estimated a coefficient. So we've found that on average, 1% increase in energy intensity means 2% increase in investment after the crisis. These are not numbers from the project. I'm trying to illustrate what an average treatment effect would look like. But actually, when we break down our sample into the most energy intensive firms, so firms that are in that 40% bucket that I mentioned before, these are really the ones that are driving the effect. So for the average firm, the energy crisis didn't really make a difference, but for the really, really, really impacted guys, it made a huge difference. So when you're looking for average treatment effects, you are finding an average effect, but it's not a true average effect. So to sense check that that's not the case, we estimate the impacts that we find for different industry divisions. And here we plot these coefficients against energy intensity. And what we would be worried about is that this has a positive slope, right? So as you see, it's kind of muted at the beginning, and you would have like a lot of action happening at the 40%. So towards the right-hand side of the x-axis. This is not what we see here. So we don't see that it is the most energy intensive firms that are driving this effect, which is good. This is exactly what we wanted to see. But we do see quite a lot of spread in terms of impact. So we want to go deeper to explore now the difference in adjustment across these margins by industry. I'm continuing on using prices as an example. So when I plot the distribution of adjustment, so how do bakeries versus hairdressers versus manufacturing of beverages responded in terms of prices? So what's the coefficient of that regression for that small industry category? And then plot the distribution of that. You indeed see, similar as to the previous chart, that there is quite a lot of variety. So there is sort of a central average treatment effect, but for some firms, for some types of industries, this is very, very different. We plot, and I know that you can't read this, but again, it's more to illustrate. So we plot that FIFA chart now at one-digit industry level. So for manufacturing, construction, accommodation, and food. And just the differences in the shape and the artiness of this graph should tell you that indeed, across all the three ways in which we've tested how our average treatment effect does in different subgroups, there is very, very rich heterogeneity in how firms adjust. This is very relevant for policymakers, and I'll use these two industries to illustrate why. Let's take manufacturing, accommodation, and food. And you see that manufacturing firms seem to have responded a lot more in terms of capital, capital that seems to have been financed more via debt. Whereas if you look at accommodation and food, the capital response is a bit muted. The price response is a lot higher. So you see accommodation and food, firms in accommodation and food to have passed on prices to consumers a lot more. From a policymaker's perspective, this suggests that more tailored policies, if we had known some of these things real time, are possible. It is possible to loosen the trade-off between fiscal constraint, targeting, and timely support by having real-time evidence of these types of differences in how firms are struggling or not struggling and the margins through which they are adjusting. The capital margin is particularly interesting because you see this happening mostly in large firms. Ideally, from a policymaker's perspective, potentially, if you think about net zero, this is a margin that you might be more interested in. So maybe with the right support, you can support firms to become more long-run energy efficient using this particular crisis as the support for this particular crisis as a moment to provide support to invest versus sort of support against the energy costs. So what I'm trying to say is that this heterogeneity really is meaningful and meaningful evidence in terms of the choices that policymakers have to make real time when a crisis ensues. Of course, while interesting and pretty, these graphs are not a structural way to investigate heterogeneity. So to do that in a more systematic way, we apply a k-means algorithm in all these different elasticities. So we take these elasticities, so the response of different industries in terms of prices, different industries in terms of survival, and all these different margins, and we run a clustering algorithm to see, are there archetypes of adjustments in the data? So are there types of businesses, types of firms, types of industries that seem to trade off capital with prices, debt with stock levels? So can we identify in a structural way, going further than these sort of graphical exercises we've gone through, these archetypes of adjustment, these kinds of heterogeneity in the data? And indeed we can, and this is probably where I'm going to leave you with and open with questions. We do find 6 types of archetypes, which we've given fancy names to here. Sort of the pass-through finance investors are industries that seem to have increased their capital spending and have done so through increasing prices. The disinvestors is another name that we've given to some of these archetypes, which are firms that seem to have adjusted to the crisis through running down their capital stock, so cutting down investment in order to adjust in other margins. The wrecked, this was the archetype that seemed to have the worst outcomes in terms of exit. And the survivors, which seem to be a group of industries that did okay. They seem to struggle, but not have had as high exit as other industries. We take these archetypes and we plot them against the characteristics of these clusters. So, okay, we find these different types of adjustment. What are these? What characterizes clusters? What is their average energy intensity? What is their average turnover? What is their average employment, management practices? What is their average markups? So this is quite an interesting exercise to characterize what are these different types of adjustments? What do they represent? What kind of industries they represent? What share of the economy do they represent? So just a summary of everything that I've said, we've created some new infrastructure to explore firm responses across various margins in real time. Doing this creates a very interesting toolkit to examine future shocks. We did so in a way that adds pre-commitment, so adds credibility to the research, which is really important. If you want to do that kind of research, go wide, but also do it in a way that's credible to be used later for policymaking. We used shift-gear design to understand the responsiveness to the crisis, and we found large heterogeneity across various margins in terms of industry and size. In particular, we found that large firms seem to invest and absorb costs more, whereas small firms seem to pass through more. So I'm going to stop here.